All right, let's jump right into this explainer on the fascinating mechanics behind reaching financial independence and, actually living off a portfolio. If you've ever looked at a crazy green day in the stock market and thought, man, what would it take to make that kind of passive income a permanent reality? Well, you were absolutely in the right place. Today, we're going to look way past the fantasy. We're going to figure out the actual math, the historical rules, and the specific step-by-step strategies together to turn your investments into a literal, self-sustaining paycheck. We've got a super clear roadmap for our analysis today. We're going to cover the crossover point, the magic tipping point, the 4% rule, dividend investing strategies, and finally, winning the decade. Let's get to it. Okay, section 1, the crossover point, or when your money makes more than you do. To really get this, let's start with the super relatable story about a retail worker named Sarah who had this sudden, unexpected realization about her money.
So picture this. Sarah's on her 15-minute break at work, right? She pulls out her phone, opens up her brokerage app, and just kind of stares at the screen twice because the numbers just aren't computing. On a totally random Tuesday, her portfolio had gained $340. Meanwhile, her entire 8-hour shift, literally standing on her feet all day, only paid her $112. For one single afternoon, her money made significantly more than she did. And wow, it's a thrilling feeling. But as any seasoned investor will tell you, a single green day on an app is definitely not the same thing as a sustainable reality. The market moves in jagged steps. The very next day, she might be down $210 before she even finishes her morning coffee.
But that tantalizing dream actually has a formal name. It's called the crossover point. It's this brilliant concept originally coined decades ago by Joe Dominguez and Vicki Robin in their classic finance book, Your Money or Your Life. They defined it as the exact month your investment income finally covers more than your monthly spending, stepping up to effectively replace your paycheck. It's the exact moment that handoff finishes, your labor steps back, and your capital steps up to do all the heavy lifting. Now, what's really interesting here is how perfectly this 19-year-old Reddit user captures that exact pivot, from the dream of a lucky green day to the reality of wanting a sustainable, repeatable plan. I mean, this user is in a fantastic position, able to invest $1,000 a week, but the core question they're asking is so universal. How is this actually achieved? Do people just take out loans against their assets? Are they relying entirely on dividends? As the community quickly pointed out to them, getting there means shifting away from chasing quick wins and really understanding the long-term mechanics.
Which brings us to section 2, the magic tipping point, finding your wealth engine's threshold. Let's look at how this builds into the concrete math of wealth creation, shifting from those single lucky days to massive, sustainable piles of capital. It's absolutely fascinating to see how the math evolves over time. Years ago, the private investor Joshua Kennan wrote about what he called a magic tipping point. He noted that the median U.S. household income at the time was $52,000, and he calculated that if you had a $650,000 portfolio earning an 8% return, it would generate that exact same $52,000 a year. Basically, it was the point where your money was effectively working a full-time, medium-wage job right alongside you. But, well, the economy doesn't just sit still. The most recent U.S. Census data for the 2020 to 2024 period shows the median household income has now climbed to $80,734. So what does this mean? It means your personal magic tipping point has to grow right alongside inflation and income standards. The goalposts move, which means your capital absolutely has to keep compounding.
Moving on to section 3, the 4% rule, the math behind sustainable withdrawals. So if you actually manage to build this massive pile of money, how much can you safely take out of it without it just disappearing? To answer that, investors look at something called the safe withdrawal rate. Now, the classic version of this is the 4% rule, which basically estimates you can withdraw 4% of your portfolio in year 1, adjust for inflation every year after that, and practically never run out of money. Sounds great, right? But it is absolutely vital to understand that this is a framework, not an exact science. Experts are fiercely debating this number right now. A prominent research firm recently dropped the recommendation down to a pretty conservative 3.9% for a balanced portfolio. Meanwhile, the actual creator of the 4% rule now argues that current retirees could safely take out 5.25%. That's a massive gap of more than a full percentage point, which really reminds us that we are dealing with robust estimates here, not absolute guarantees. So let's just use 4% as the plain middle ground to see what it looks like in reality. Imagine you've built up a $100,000 portfolio, which, by the way, is a milestone a lot of dedicated long-term investors hit way before traditional retirement age. At a 4% withdrawal rate, that portfolio safely produces about $4,000 a year, or roughly $333 a month. Now, okay, $333 a month is not going to replace a full-time paycheck, but think about this.
It is already more than Sarah earned in her entire grueling 8-hour retail shift. And more importantly, it's repeatable. It isn't some lucky market fluctuation, it is a sustainable mathematical engine.
So the absolutely crucial point here is applying this math to the actual finish line. For Sarah to fully replace her specific retail salary of roughly $33,800 a year using that exact same 4% rule, she would need a portfolio worth roughly $845,000. Now, I know seeing a number pushing $1 million can feel super staggering, but it's really not meant to discourage you. It's meant to replace a vague fantasy with an actionable, highly concrete target. Full replacement is the finish line, not the starting line.
All right, Section 4, Dividend Investing Strategies, the vehicles to generate passive income. To actually get to those massive numbers, like Sarah's $845K, we really need to dive into the how. Specifically, we're going to look at how dividends act as a key engine for compound growth, drawing on the comprehensive FINSA methodology.
To avoid getting completely lost in the financial weeds, let's break down 4 very distinct approaches to dividend investing. What becomes clear really fast is that your choice depends entirely on your timeline and your needs. If you're a long-term investor, the dividend growth strategy focuses on companies that consistently grow their payouts, giving you massive compound growth over decades. If you're already retired and need cash today, the high-yield strategy targets assets paying 4 to 8%, though you've really got to be careful to dodge risky dividend traps there. And value investors? Well, they might love the contrarian dogs of the Dow approach, which just involves mechanically buying the highest-yielding blue chips in the Dow Jones every single year. But if you're looking for an incredibly resilient core holding, you really have to look at the dividend aristocrats. Guys, these are the elite of the elite in the S&P 500. To even earn this title, a company must have not just paid but actually increased their dividend for at least 25 consecutive years. We're talking about heavyweights like Coca-Cola or Procter & Gamble. This kind of remarkable track record demonstrates just exceptional financial discipline and a proven ability to thrive through multiple economic cycles, recessions, and even market crashes.
But perhaps the most powerful tool for someone in the accumulation phase, like that 19-year-old Reddit user we were talking about earlier, is a DRIP. That stands for a dividend reinvestment plan. Instead of just taking your dividend as cash, a DRIP automatically uses those payouts to buy more fractional shares of the stock. It literally puts your wealth building on complete autopilot. Your growing number of shares generates larger dividends, which then buy even more shares, exponentially accelerating your wealth over the decades. It's a total self-fueling growth engine.
And that brings us to our final section, Section 5, Winning the Decade, Building Repeatable Wealth Over Time. Let's look at how to pull all of this theory, math, and strategy together into a practical, day-to-day approach. The Simple Stacks methodology highlights that investing really isn't about outsmarting everyone or winning a single lucky Tuesday. It requires 3 kinda unglamorous but totally necessary steps. Step 1. You have to invest on an automatic schedule, whether the news is exciting or terrifying that month. Just do it. Step 2. Keep your costs low. Spreading your money across broad index funds means you own the whole market and just let it do the work, rather than making narrow, risky bets. And step 3, which is definitely the hardest, have the patience to sit on your hands during down years. Selling in a panic doesn't just lock in a loss, it completely erases the years of compounding meant to fix it. Sarah, our retail worker, she shifted her mindset. She realized she isn't trying to win a single day anymore, she's trying to win a decade. By stopping the chase for those lucky green days and committing to consistent math over time, financial independence goes from this far-off daydream to a completely reachable destination. Yes, it's slower than a flashy headline, but it is so much more reliable. So, looking at your own life, your own expenses, and your own big goals, the only question left for you to answer is, what exactly is the specific, personal magic number you are aiming for to hit your crossover point? Think about it. Thanks for joining me for this explainer, and keep building that wealth.